Welcome to The Explainer. So today, we're jumping into one of the most exciting, and let's be honest, one of the riskiest moves in trading, the breakout. We're going to break down how to spot them, how to know if they're for real, and most importantly, how to dodge those fakeouts that trip up so many traders.
You know the dream trade, right? You see a clean breakout, you get in, and you ride this beautiful, profitable trend. But the reality is often the nightmare on the right, the fakeout. The price pops, you get all excited and jump in, and then, boom, it slams right back down, hitting your stop loss. It is the classic trap, and this whole explainer is about showing you how to see it coming.
So, to stay out of that trap, we've first got to understand the battlefield. And really, it all comes down to two key ideas that every single trader needs to master: support and resistance. Just think of it like this. You've got a floor and a ceiling for the price. Support is the floor. It's a price level where buyers seem to always show up and hold the line. Resistance, that's the ceiling, where sellers take over and push the price back down. A real breakout? Well, that's when the price finally gets enough power to smash right through that ceiling or floor, signaling that a whole new trend might be starting.
Thing is, these big, powerful breakouts, they don't just happen out of the blue. They usually build up over time, and they form these really recognizable patterns on a chart as the fight between the buyers and sellers gets more and more intense.
So your first job is to get good at spotting these formations. It doesn't matter if you're looking at stocks, crypto, or Forex. Patterns like a head and shoulders, an ascending triangle, or a falling wedge, they're all just visual clues that the market is winding up like a spring, getting ready to make a big move.
Okay, but this is the million-dollar question, isn't it? Because seeing a pattern is one thing, but putting your money on the line is something else entirely. If you jump the gun on a false signal, that's exactly how traders get burned. So, how do we get the odds in our favor?
This is where we shift from just spotting a pattern to actually confirming it. Look, successful trading isn't about gazing into a crystal ball. It's about being a detective. It's about gathering clues and looking for evidence that a real move is underway.
So you need to become a trading detective, and lucky for you, there are three main clues you're always going to look for before you even think about entering a breakout trade. We're going to look at each one: the price action, the volume, and then an optional clue for the more conservative folks, the retest.
Okay, first up, and this one takes a little patience, you have to analyze the price action. Specifically, we're talking about the breakout candle. A lot of times you'll see the price just poke its head above a resistance level for a second. That's called the wick, and then it falls right back down. That doesn't count. That's a trap. What you need to see is the main body of that candle close decisively outside the level. The bigger and stronger that close, the better the signal. Now, for our second clue, volume. And let me tell you, this one is a deal breaker. A perfect-looking chart pattern that breaks out on low volume is like a rocket ship with no fuel. It might look impressive on the launch pad, but trust me, it's not going anywhere. So how much fuel do we need in the tank? Well, as a rule of thumb, you want to see a volume spike that's at least 50% higher than what it's been trading on average lately. This is your proof that other traders, big institutions, are jumping on board with conviction.
In fact, it's pretty simple, really. The bigger that volume spike, the higher the probability that the breakout is the real deal. When you see volume that's 2, 3, or even more times the average, that's showing you there is some serious belief behind this move.
All right, our final clue. Now this one's for the more patient, more conservative traders out there. It's called the retest. Sometimes after the price smashes through that old ceiling, it'll actually pull back and touch it one more time, almost as if to test that the old ceiling is now the new floor. It's a really powerful confirmation, but you gotta have patience, and you have to accept that you'll miss some moves that just blast off and never look back. Okay, so you've done your detective work. The candle closed strong, the volume was huge, maybe you even got a retest. The evidence is stacking up. Now what? Let's get into the nitty-gritty of how to actually structure the trade.
Look, every single trade you take needs three things, period. You need your entry point, you need your stop loss for when you're wrong, and you need your profit target for when you're right. So let's use this Filecoin chart here to walk through each one.
First up, your entry point. This is your moment of commitment. Based on all the evidence you've gathered, that strong candle close, that big volume spike, this is the exact spot where you decide, okay, I'm in.
Next, and arguably the most important part, is your stop loss. This is your safety net. Before you even start dreaming about profits, you have to know exactly where you're getting out if the trade goes south. A stop loss is a preset order that protects your capital automatically. It's your eject button.
And finally, you have to have a goal. You need to know where you're going. A professional trader decides where they're going to take their profits before they even enter the trade. A really common way to do this is to just measure the height of the chart pattern itself and project that same distance up from your entry point. All right, we've talked about a lot of charts, tactics, and tools, but the single most powerful tool any trader has, it isn't some fancy indicator or secret pattern, it's a principle. It's a mindset. And let's be really clear about this. Your long-term survival in the markets has almost nothing to do with how good you are at picking winners. It has everything to do with how well you manage your risk, especially on the trades that don't work out. One of the simplest, most powerful ways to do this is with the 2% rule. It's super simple. It just means that on any single trade, you never, ever risk losing more than 2% of your total account value. This one rule ensures that no single loss can ever blow you up. It keeps you in the game. So let's make this real. Say you have a $10,000 trading account. If you followed the 2% rule, what's the absolute maximum amount of money you are allowed to lose on this one Filecoin trade? $200. That's it. That's your line in the sand.
And this right here, this is how professionals think. They don't just guess how many shares or coins to buy, they calculate it based on their risk. If your stop loss is 8% away from your entry, and you know you can only risk $200, well, the math does the work for you. You take your max dollar risk, $200, and you divide it by your trade's risk, which is 8%. And that tells you your exact position size, $2,500. You have perfectly defined your risk before you even hit the buy button.
And that's really the heart of it all. Successful trading isn't about being a fortune teller. It's about being an excellent risk manager. It's not about being right all the time. It's about having a disciplined process that protects you when you're wrong. So the real question to ask yourself isn't, can I predict what's next? It's, do I have a process?